Hello everyone, I'm Peter An. Today we are diving into these critical questions. Before we start, I can tell you, my stance on this question is yes. To justify this position, let's explore the current landscape and emerging trends in climate change accounting and reporting. First, let's talk about ASIC and ACCA identify greenwashing as enforcement priorities. Although there is currently no clear law in Australia to restrict greenwashings, on June 28, 2024, the Australian Senate will obtain an investigation report on issues related to greenwashings. Internationally, countries such as the UK and EU have already established relevant law to restrict and punish related behaviors. This shows that this behavior is increasingly subject to scrutiny by ASIC. In addition, as we can see in this slide, also some companies gain short-term competitive advantage through false and misleading information. Once they are discovered, they will face penalties and a decline in corporate reputation. For the part 2, the FRS S1 and S2 standards aim to increase the transparency and comparability of sustainability reporting, taking into account the Australian Accounting Standard Board's adjustment to the SSP standards. It is evident that the Australian Accounting Standard Board has made the relevant standards more detailed, clear, and suitable for Australia. They change more towards standardized, high-quality climate-related disclosures. This standardization is a step towards ensuring that the climate-related reporting is treated with the same seriousness and consistencies as financial reporting. Therefore, companies should pay attention to this draft. For part 3 in Australia, the NGR Act requires companies exceeding a certain threshold to disclose their emission data. Additionally, the Treasury Laws Amendment Bill 2024 mandates that certain companies submit a sustainability report disclosing climate-related risks and opportunities. This regulation specifies the greenhouse gas emission data that company must report to ensure transparency and consistency. The mandatory reporting system holds business legally accountable for their carbon emissions, promoting them to take concrete action to reduce emission. Voluntary disclosure can enhance corporate transparency and regulations, help to attract the trust of the investor and customers, thereby boosting the brand value. Many companies set internal emission reduction target and public disclose their progress to encourage competition and collaboration within the industries, driving the achievement of overall reduction goals. For example, Australian companies such as ANZ, Optus, Taylor Swift have all undertaken such initiatives. It can be said that both mandatory and voluntary accounting mechanisms play a crucial role in driving Australia towards achieving its 2030 emission reduction targets. And next, for the part 4, I think this will require companies to disclose more detailed information about their water use and management, including information on water consumption, recording, and discharge. Additionally, more detailed environmental impact assessment are needed to understand the specific impact of their operation on water and marine resource. In international competition, greater transparency and compliance can enhance stakeholder trust and support, potentially leading to more positive business opportunities and reputational improvements. For example, Toyota's 2023 report fully demonstrates its information on water resource use and discharge. However, complying with these new reporting standards may increase compliance costs of companies, including training employees, upgrading system, and hiring third-party audit and verification service. In summary, Australian companies that adapt and implement this standard earlier can gain an advantage in international markets and remain competitive. That's all. Thank you.